The goal of every dividend investor should be to someday live completely off the dividend distributions of their holdings. Unlike growth investors and index fund holders who do have to rely on selling shares of their stocks, someone who can live solely off their dividends without ever having to sell any of their capital, I think is in a much better position. If you never have to sell shares of your holdings, then you'll never have to worry about share price fluctuations. It's also the most passive form of income available to anyone. Like clockwork, every single quarter or month, you'll receive your dividend payments without ever having to lift a finger on your end. But picking good dependable dividend ETFs can be difficult if you don't know what to look for. Some people are tempted to just go out and invest in the highest yielding ETFs they can find, and what usually happens is they get burned out by dividend cuts. In this video, we'll take a look at some dividend ETFs that are ideal for people who want to achieve the goal of living off dividends even at an earlier age than what's considered typical. These are all ETFs that I personally own, and for the record, I'm not sponsored by any of these companies. I'm putting my own money where my mouth is when it comes to these investments. When it comes to picking dividend ETF investments, there's a few things that I look for. Although it's not required, an ETF that pays monthly dividends is always better. Now that doesn't mean that you should sacrifice quality for a monthly paying option that exists, which I commonly see people do. But obviously monthly payers make budgeting easier as opposed to only getting paid every quarter. Its holdings should be well diversified across many different sectors unless you're investing in a sector-specific ETF. It should also have a very solid track record of performance, meaning consistent dividend and share price growth if it's a lower yielding fund, or very minimal dividend cuts if it's a higher yielding investment. Share price declines or NAV erosion shouldn't be an issue either, which can be common for these high yielding holdings. An ETF that I believe every dividend investor should own, no matter what age or how long you've been a dividend investor, is SCHD. Regardless if you consider yourself more of a high-income investor or a traditional dividend growth investor, SCHD is a great ETF to hold if you want to live off dividends. For those that are pursuing a dividend growth strategy, this fund offers some of the best long-term dividend growth out of any investment out there. According to Seeking Alpha, SCHD has been able to deliver a 5-year dividend growth rate of 12%. This is faster than any dividend growth ETF out there that I've come across, including VIG from Vanguard and DGRO from iShares. If you're an income-only investor, then holding SCHD or a similar dividend growth ETF will ensure that your income continues to rise when you're retired. If you're targeting only higher-yielding investments, which often don't usually offer much dividend growth, then your income growth will slow down if you're not reinvesting your dividends. Dedicating some of your portfolio to SCHD, even just a small percentage, will help ensure your income will keep growing when you're not reinvesting all of your dividends. It's also tax efficient in that its dividends are qualified and are subject to less taxes. This can make SCHD a much more appealing investment if you hate taxes and yet you want to invest outside of a retirement account. However, there is a problem with SCHD that exists for a lot of people who want to live off dividends. Despite its excellent dividend growth that'll ensure your retirement income keeps growing, it only yields 3.3%. This means that if you want to depend on SCHD for a lot of your income, you'll either need a large sum of money right now or you'll need to wait a long time until you're invested enough in it. With a 5-year dividend growth rate of 12%, if you're younger and remain committed to investing a good amount in this ETF on a consistent basis, you can achieve this before the typical retirement age. However, if you don't have a large sum of money today, like upwards of $1 million, or you don't have a lot of time on your hands, or you don't think you can save a lot of money, then you'll want to consider holding other ETFs in addition to SCHD. One of those additional considerations would be the InfraCap US Preferred Stock ETF, ticker PFFA. This ETF holds a collection of preferred stocks and applies a small amount of leverage in order to boost its dividend yield. Preferred stocks are investments that are considered safer than common stock because they have a higher claim to assets in the event of a company failing. Although they aren't known for their growth, preferred stocks come with very high dividend yields, and preferred shareholders must be paid dividends before common shareholders can receive any dividends. This makes them ideal for investors who want a safer, higher dividend. But there's a couple issues that exist when it comes to investing in preferred securities outside of an ETF like PFFA. Many of them are thinly traded, meaning that it's not ideal to accumulate a large position in any one preferred stock. It can also make things hard when it comes to diversification, because it's more ideal to have more holdings due to the safety diversification brings to your portfolio. This can be a challenge since you have to own several thinly traded investments. This is why I always recommend people buy a preferred ETF as opposed to buying them individually. What's even better is that PFFA pays a monthly dividend, whereas most individual preferred stocks pay quarterly. Right now it offers a dividend yield of almost 9%, meaning that it pays more than 2.5 times what SCHD currently offers. Again, it doesn't offer the same kind of growth SCHD does, but it takes much less money invested to actually receive a worthwhile amount of dividends from PFFA. The diversification of higher yielding, safer holdings make an ETF like PFFA worthy of consideration. A $50,000 investment in this fund at today's share price would earn you a little over $4,400 a year in dividends. That's obviously not enough to retire off of, but for comparison, that same investment in a more popular dividend stock like Procter & Gamble would only get you $1,100 a year. Plus, reinvesting all of that $4,400 a year in dividends is really going to create a nice snowball. So if you're motivated by high income, then these kind of ETFs are going to be great for cash flow. But there's other options out there that offer high yields without getting too risky. If you're looking for an ETF that pays high dividends and offers more tech exposure, then the JP Morgan Nasdaq Equity Premium Income ETF is one option. JEPQ is an ETF that implements written out-of-the-money Nasdaq 100 index call options that seek to generate distributable monthly income. In addition, they use what they describe as an applied data science approach to fundamental research and portfolio construction. JEPQ's dividends do vary from month to month because it uses a covered call strategy, so some months will pay more than others. I would also call this ETF a little riskier because it's overwhelmingly made up of tech stocks. If tech experiences a massive sell-off, then the share price of JEPQ is going to be much more impacted than the other ETFs we've looked at. Also, the amount it pays each month depends on how market volatility currently is. So it doesn't pay a fixed amount like PFFA does. The distributions have been pretty consistent though, and right now JEPQ currently yields over 11%. But again, this does change from month to month. Sometimes it'll be more and sometimes less. It's also been really good when it comes to share price growth, which is a rarity for something that offers a yield this high. This can mostly be attributed to the tech boom we've been experiencing. So overall, JEPQ is still a really nice choice to be a part of a higher yielding portfolio. To this day though, my favorite high income ETF is still SPYI, the NEOS S&P 500 high income ETF. This fund invests directly and through derivatives in stocks of companies that are operating across diversified sectors and uses derivatives such as options to create its portfolio. This ETF seeks to generate high income from the premiums earned from SPY call options as well as dividends received from the fund's equity holdings. It's well diversified since it invests in the S&P 500 index and it sees really good share price growth unlike other S&P 500 covered call funds that exist. This is because of its strategy in which it utilizes a call option strategy which can include both sold and purchase SPX index options. This can provide the opportunity for better upside capture in rising equity markets. SPY currently offers a yield exceeding 12% according to its website, and if that wasn't appealing enough, this fund strategy also includes tax-saving efforts. Because it's an actively managed fund, they seek to use tax loss harvesting opportunities when appropriate, and their distributions are classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Although it's not as tax efficient as SCHD, it's better than most high-yielding options that exist. This again can make it more appealing to hold outside of an IRA if you're not planning on waiting until you're 59.5 to retire. So all of these things and more are the reasons why I like SPYI so much. But ultimately, I just want to say this about retiring off dividends. I'm not like other people on YouTube. I won't try to tell you that an early retirement is easy for everybody watching this. A good number of people watching won't actually achieve an early retirement off dividends, but that shouldn't demotivate you from pursuing dividend investing. When you do retire, if you're earning $1,000 a month in dividends, that's still better than nothing and far better than the vast majority of people. You will really appreciate having that extra income each month. So don't get discouraged if you are starting very late or if you don't have a lot of money to invest. You can still receive good monthly payments if you are starting very late or if you don't have hundreds of thousands of dollars saved up. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.